afternoon to all of you in the room and to those joining over the internet. It is a great pleasure to be here, and I thank the BCS, and in particular Chikezie, in the Finance Services Specialist Group for the opportunity to present on this topic. So, as has been said, I'm a lawyer specialising in securitization, which is a very specific area of finance. And like the vast majority of my colleagues, I don't come from a technological background and have to date been mostly involved in traditional finance transactions. However, as you all know, times are changing and disruptive financial technology has been surely, well, but slowly, making its way into the day-to-day lives of lawyers. And so this has sent many lawyers, such as myself, on a quest to find out how our specialist areas will be impacted by the new financial system world order that is budding. This session is precisely about that journey. So before we dive into the topic, I suggest we drill a bit down on what securitization is, just so that people who specialize in other areas know what I will be talking about for the rest of the session. So securitization is essentially a financing technique and is one among many others that allows certain assets not otherwise easily tradable to be monetized. So the classic example, the archetypal example, is a pool of residential mortgages that is originated by a bank. So the bank has granted mortgage loans to its customers and is entitled to repayment of the amount lent plus interest and fees. This entitlement is an asset of the bank. However, it's not easily tradable. That is, unless you securitize it. And how do you do that? Well, there's a bit more to that. I've been doing this for a couple of years, and there's a whole industry focus on this. But typically, you would sell the asset to a company you have just created for that purpose. So we call it special purpose vehicle, or SPV, as many of you are familiar with the term. And the SPV issues notes to investors or borrows from lenders. And with that cash received from investors, it pays the purchase price on the asset, so on the pool of mortgage loans. Then the SPV will repay the debt owed to investors using the cash flows generated by the assets, i.e. the principal repayments plus interest and fee payments. And this is broadly how a securitization in its purest form should work. The end result in this example is the bank monetizes the assets, so the entitlement to receive repayments from customers straight away, instead of needing to wait, say, 30 years or until the maturity of the mortgage loans, and has an option to remove, well, has the possibility of removing the assets from its balance sheet. In turn, investors invest in the SPV debt, but become ultimately exposed to the credit risk of the mortgage loans, so to the credit risk of the individual customers of the bank. And so this dispersion of risk might be attractive from a risk perspective, a credit perspective, and because you have isolated those assets from the bank and all the issues that banks may be subject to, it's potentially a better deal than lending to the bank directly. And so this is, in a nutshell, what a securitization is. There are, of course, many permutations of this type of financing, and it takes many forms, and it's not as simple as this. And there are many other drivers for engaging in these transactions, so a case-by-case analysis, you can't just go without it, but this is how it's broadly supposed to work. Now that we've gone through this brief introduction, let's dive in on the legal and regulatory framework applicable to securitization. So, usually, when you think about financing transactions, you might think of loans, bonds, but securitization has a distinct feature, which is it's one of the only types of financing, forms of financing, that has a dedicated legal regime. This is true in the EU and the UK, where you have regulation, so the securitization regulation in the EU, and very recently, from the 1st of November this year, a new UK securitization framework. And this is largely due to lessons learned during the global financial crisis, which motivated some ground rules to be set by regulators so that the same mistakes and the same disasters don't materialize again. These rules in the EU and the UK are essentially substance over form, so they apply to a wide range of transactions, provided certain features are present. So for those of you more familiar, you've heard the term tranching, and that's a telltale sign of there is a securitization there, we should regulate it and apply the relevant rules. And so, at least conceptually, these regulations could also apply to securitizations that are done on-chain, so using elements of DLT, including blockchain. But what about these rules? And so what, you might ask? So these rules dictate the need for parties, both on the sell and buy side, so whoever is setting up the transaction, and investors, to comply with certain requirements. And these requirements may be, depending on the context, quite onerous. And that's why we need to look into this and just make sure what applies if you're doing an on-chain securitization. Are you caught by these regulations? Are you not? So we do need to look at it. So looking at the EU, MiCA, so the Markets in Crypto Assets Regulation in the EU, expressly excludes from its scope of application any crypto assets qualifying as securitization positions, as defined in the Securitization Regulation. So if we want, the bottom line is, if we want to do a securitization using DLT, this will be subject to the existing regime. But you might ask, we have a dedicated regime for crypto assets, so why are we using the old regime? Well, that's an excellent question. Sorry, bear with me. And the trouble is that the securitization regulation, so the securitization specific regime, has been crafted with a traditional financial system architecture in mind. So in a way, it might be at odds with some elements of on-chain transactions, and is not prepared from the outset to deal with those. Although it can work, so it's quite a substance over form piece of legislation, at least in the EU and the UK, I mean, is substantially equivalent for the moment. Although it can work, there is a problem. There is extremely limited experience in applying these rules to trades using DLT and blockchain. And on the other hand, it is unclear what the position of regulators is on whether what you do with it actually complies with the regulation or not. So there is a black box of regulatory risk lying there, which kind of makes, at least in theory, investors unsettled. And so we've got our problem here. But there's a problem, but there is also something very positive, which is the benefits that we could have by applying DLT elements to securitization transactions. So for those of you who have worked in securitization or have had contact with securitization, you will probably agree with me that securitization is a natural candidate for automation and standardization. So the way deals work and the way transactions are structured lends itself to lots of comparisons with self-executable programs to the extent that in certain cases, your transaction works as a closed ecosystem and requires very little outside intervention or input. So the transaction can be programmable. And so when you look at it, distance yourself from the transactions you structure and look at it, and you realize it's a natural candidate for this type of transaction. Also, because as we discussed, the credit risk associated with the underlying assets is what you're really looking at in a securitization. That element of having traceability of assets, immutability of records, possibility of having an audit trail is desirable and is actually a big bonus. And if you pair that with data quality and integrity and transparency of that data, there can be very substantial benefit Just imagine a world in which investors know what the asset is, there's an immutable record, and that information is freely shared with all participants. That is really, really a dream, at least from what we can experience from speaking to investors and to regulators who look at these transactions. Furthermore, where securitization involves a capital market settlement, so for instance, if you have the SPV issuing bonds, there may be many, many benefits of using DLT, which actually apply to capital markets in general. And I've taken out a sentence from the recentish in this world, August 2024 AFME Roadmaps for Scaling DLT-Based Capital Markets paper that says the use of DLT can offer transformative and tangible benefits compared to traditional infrastructures. Programmable settlement, more cost-effective management of issuances through the automation of workflows and corporate action, as well as reduction of single point of failure risk in financial market infrastructures. Ultimately, these benefits can reduce costs for investors and improve the efficiency and resilience of European capital markets and even enhance liquidity. So I've listed out in the slide a couple of potential benefits for securitization when using DLT. This list is not exhaustive. There are countless articles and papers discussing all of these benefits. And so I'll probably keep it simple and say that there is a lot of benefit, and securitization is a sizable market and is recognized, including at an EU level, it's very en vogue, as one of the crucial tools to unlock investment and support the real economy. So why is securitization missing out on all of this? There must be an explanation. So it would be useful to check in where we are now with this, because of course I've spoken about the bad things, the good things, but how is the state of play currently? So it's kind of difficult in a way, because information is fragmented. You get a lot of information through press releases and LinkedIn posts, but there's not a reliable source where you can find all the information, despite attempts by organizations, industry associations, to just streamline and present all that information. But the fact is that there have been a number of proof of concept on-chain securitization transactions that have over time repeated and become a lot more frequent. So, such as Grey Peak 2021, so securitization of unsecured corporate loans originated by Bankfreak, done on the Kadaya platform. The more recent May 2024 Fazanara and Untangled Finance transaction on the Silo blockchain. A digital bond on the Ethereum blockchain backed by US Treasury bills in April 2024. And on more the covered bond side, the August 2024 Natixis Brief Bank, so the first digital covered bond, and so on. And I could be, it actually has quite a useful list of transactions that have been happening on the digital asset space, and there are many more. And this is the tip of the iceberg, because most of these transactions are not actually publicized. And so what we're witnessing is that there have been all these attempts and all these experiences, but we can't really map them out all. But it is out there. This happens, but while there's increasingly widespread use of digital components in off-chain transactions, for instance, through issuance of digital bonds, the smart asset origination, so the origination of digitally native assets for securitization, seems to be, although there's no data really that I could find to support this, appears to be, for market perception, lagging considerably behind. But with more intense uptake in some sectors, for instance, trade finance, you do see the frequency of press releases and of initiatives, and it tends to focus on a couple of areas. So for instance, mortgage loans, consumer loans, there does not seem to be at the moment sufficient critical mass of assets to support origination that is sufficient to feed on-chain securitization transactions as a whole. However, enthusiasm and momentum is growing. So you, of course, have seen all the sandboxes, pilot schemes in the EU, in the UK, the legislative activity, industry focus. The very fact that we are here discussing this, there is momentum and enthusiasm. And platforms, protocols, and other tools and technical solutions have been developing at quick pace, both through startup ventures and through established entities. So a notable example is the HSBC Orion platform for blockchain tokenization. But the market still remains fragmented. So there is, as I mentioned, very little centralization of information, no reliable sources, and we kind of pick up hints on what other people are doing through conversations, conferences, LinkedIn posts, press releases, and so it is a bit piecemeal. I think everyone shares the sentiment that we would actually like to know more about it. So it's really difficult to assess the state of development and status quo of the market at this point, except that we know that something is brewing. That's a distinct impression that I and many people I've spoken to share. So, what is keeping us from widespread adoption? Why is this not picking up massively? So DLT is making its way into securitization, but it's still very early days. So technical aspects, which the audience is probably much more well-versed to speak about, are reportedly still an issue. So data integrity and security, which is essential for building investor confidence, information sharing, and barriers that need to reflect the transaction. Those technical aspects are always a point of discussion, and there are countless others that I am not even in a position to describe, but I leave to the audience to think about. The second one is a small ecosystem of service providers. So naturally, if your investor base is not there, who are you providing services to? Why are you developing solutions? So naturally, this is going to be an issue. Third, very, very important, interoperability issues. So we realize that we are not in a mature stage to go fully on-chain. So there will need to be part of a transaction that is off-chain and part on-chain. If the off-chain segment does not communicate with the on-chain segment because of interoperability issues, then it kind of doesn't work. And that's one of the main issues. Also, between the various DeFi platforms, and even within the same platform, interoperability is an issue. And now we've seen, well, a while back, we've seen development of common standards and conventions. So for instance, ERC standards on the Ethereum blockchain. So that is all moving and improving, but there are still pockets of issues there. Not so much on the technical side, but on the more, let's say, traditional financial system architecture side, various entities in the industry have been making efforts to create frameworks. So, for instance, Euroclear and Clearstream are now focusing on the framework for this type of assets, and it's all coming at the same time, and it's a big melting pot. Let's see what comes out of it, but it's just to solve this very, very important issue, which is interoperability. And legal and regulatory uncertainty. So this is actually the topic of the session. The sandbox and pilot regimes are a safer space for exploring solutions, but you can't scale up anything if you're doing experimentation at a smaller scale. Cross-border aspects are still an issue, and different areas of law advance at different speeds, and that also throws a spanner in the works. So, in short, largely a consequence of all the above, but the investor base is still limited to a few key players, and if you have a limited investor base, the incentives for developing solutions is not there, and limited progress further exacerbates the limited investor base. So we kind of have a chicken and egg problem that will need to be solved somehow. So silver linings, what can be done? Waiting for all the hurdles to be solved is not realistic, and it's not going to lead to quicker adoption. So the key is to engage some on-chain elements, well, in my view, to engage some on-chain elements, even if not all the transaction can be brought on-chain. So for example, a traditional securitization, your assets are real-world assets, they're not on-chain, but you are still going to do that securitization and issue a digital bond, because at least you have something that is DLT. And you start to create the market, you start to create the demand, you start to socialize the idea, so it becomes the new normal. Developing technical solutions continuously, that is a no-brainer. And a key point is engagement with regulators, both in relation to new legislation, but also how existing frameworks work in a DLT context, so notably the securitization framework. Working with industry associations to develop market consensus, practice, build critical mass, and overcome collective action problems, very important. And engaging with rating agencies. Rating agencies have put out papers on credit risk impact of DeFi protocols for securitization. So they are clearly interested in this sector, and they should be an integral part of this solution. And also, naturally, common taxonomy and standardization to make sure that the legal and regulatory framework actually becomes stable and everyone is functioning according to the same taxonomy and standards. Smart assets will be crucial to the transition to an on-chain environment, although they might lag behind. But there is the option of smart asset origination from the outset, or tokenization of real-world assets, which would be a quick fix to just try and get everything on chain as soon as possible. Finally, are we in the long and winding road, or are we going down the yellow brick road? Well, I don't know. But there is a clearly compelling case for widespread adoption. However, as you all know, inertia still dominates most decisions and can only be overcome by education on these matters and by socializing the benefits and the incentives to use DLT in securitization transactions. So every transition has its growing pains, and this particular one will require an interplay between legacy transactions and new transactions, potentially forcing two systems to coexist, and that is costly, that is slightly ineffective, and maybe really confusing, especially for people who haven't really bought into the idea of transitioning into the DLT world. So there is some hope because TradFi and DeFi, although they're still very much in parallel circuits with activity happening in a pretty much siloed manner, are converging together. And large institutions, so big banks, for instance, are very, very responsible for that gap being bridged and for that difference between systems being erased. And working in a concerted manner benefits everyone, because there's a wider investor base, there's synergies, there's learning, and there's no fragmentation. So it makes the markets come together, and that has, of course, all the advantage. But more importantly, regulation has not quite caught up yet on all fronts, and it is simply not possible for investment to thrive on the basis of a regulatory environment that is shaky, experimental, tentative. So controlled environments such as sandboxes, and I always tend to think about them as ponds, where you can experiment and not drown if you're making an experiment that doesn't go quite so well, will allow for learning experiences and for building track record and market confidence. But they will never, ever, ever replace the need for transactions taking place in the open sea, even if you don't use a public blockchain and use permission blockchains because of structure or regulatory considerations, money laundering, etc. Momentum is building, and we should not let it go. And it is on each and every one of us to help bring this exciting project to fruition. And I know that I can count on this audience. I've had very enthusiastic conversations just before we started, and I hope we can continue the discussion. And that is all from me on the presentation today. Thank you.
Thank you, Joana, for that wonderful presentation. I mean, that was just well received by the audience and very insightful. Thank you very much. So I now open the floor for the Q&A session. So please feel free to ask questions. Okay, do you want to start first? Yes.
I have two questions. One is in terms of tradable securities, there are two ways to, in my perception, there are two ways in pricing them. One is like the stock market that you use the revenues and compared with the bond and volatility and sum up together. And the other is like the commodities, and you can use the demand and production as a model to pricing, and people just speculate. I think for cryptocurrencies, things like this, more like this, and its usage is more for kind of a gray or even black market payment, and also the regulatory evasion of asset allocation, very commonly seen in China, as I see it. So it's a. Would you think the regulatory measure will be tightened in the future? Should we, in terms of DLT and also the crypto things? The second question also, let me finish. The second thing is about, very simple, is what do you think about the impact of upcoming quantum computing, which certainly will break up or every DLT things?
So on the pricing aspects, being a lawyer, I'm notoriously bad with numbers, and I will shield from commenting on the financial calculations around those. But it would be expected that at least in an initial stage, that tradable digital bonds would pretty much work as a normal bond. So they would be traded on a stock exchange that has, of course, the capability to deal with digital assets. There's already that exists, and that there is the pricing mechanisms in that exchange would apply. Of course, when you're talking about assets, you can buy them in the open market, and then the pricing would be defined like that. But of course, you have all sorts of permutations of private transactions that could be done on different terms. So that's something to think about, is the exchange-based trades versus in the open market versus trades that are done on the closed market. I don't know if that answers your question. I'm not sure how that's going to evolve. That's the bottom line, and I think to a certain extent it will depend on the direction of regulatory travel and whether you kind of glue yourself to the traditional financial system and how exchange traded bonds work, or if you go in a completely different direction and lose the link between the traditional bonds and the traditional pricing mechanisms, and you go more on a cryptocurrency path. To be honest, I don't know, and I'm not sure if anyone knows yet, unless you're in a regulator masterminding for the future, how that's going to play out. In relation to quantum computing, that's a bit in the same bucket as AI, and I've intentionally avoided that because we're trying to solve for one problem. I love when people talk about how can we make securitization go on chain, and then they say, oh, what about the role of AI? Well, now you have two problems. You started with one and you have two. So quantum computing, I am not technologically able to speak to you about quantum computing as much as I would like to, but it seems to me that if you're taking 2 steps instead of 1 at a time, you might not get anywhere. But quantum computing and AI will surely be disruptive. And I don't think that regulators have even got to the point where they're comfortable with DLT, let alone how that interplays with other aspects. So sorry if that's not a very fulsome answer. But
I think they.
Oh yeah, hi, my name's Richard. You mentioned origination of smart assets versus kind of tokenization of existing assets. And I was just wondering, because securitization often, involves real world assets, things like houses and cars, and or even things like invoices. And there's kind of like a whole sort of chain of contracts that need to be relied on. How far, I guess, how far does the tokenization or the smart asset have to go? Because you could have like a financing agreement. Does the deed of the house, would that ideally also be digital? Or if you're doing trade receivables, do the invoices need to be smart? And will there always be that friction between the real world and the on-chain world?
That is, I need to make a precision because I spoke about tokenization of real world assets. So securitization as we typically see it, and of course there are gray areas, but as we typically see it, it's the technique of monetizing cash flow generating assets. So for instance, you can't really securitize a house. However, you can securitize a mortgage loan that is secured on the house. And so I think instinctively you would stop at the point of the financial asset being securitized, and that's really what you need to bring on chain. So you do not need to bring the house on chain because you don't really need that. Having said that, I have heard, and I don't know how verifiable this is because of course I couldn't anticipate your question, that there are numerous initiatives to try and bring, for instance, land registry in a digital format. So I think that the whole ecosystem will, try to be more digital to enable, for instance, mortgage loans to be done in a fully digital way, and also link up with the registry, the land registry. So in a way, I think what we need for a securitization is the financial asset. And if you are bringing that asset on chain, then what you need to focus on is that financial asset, not the tangible asset that secures it somehow.
Okay.
Yeah,
Well,
there's
someone
a
from
couple
the-
online, Joe. There was one from David Lewis. It says, do you see a risk in the recent move to securitize buy now, pay later debt? Joana, etc.
That is a very interesting question. I mean, there's regulation forthcoming. I'm not a buy now, pay later specialist, so I'll make the caveat, but in a way, technology has its own risks, but in terms of the assets, it should be risk agnostic, because the assets are the assets, and you can introduce some pockets of risk because the way they're represented. So if you have, for instance, mortgage loans that are solely done on paper with no records, you have obviously the risk of physical destruction of that contract, which is the same as having it on chain. You have the risk of that contract somehow not being properly input on the system or inserted on the chain or something like that. I mean, that becomes a bit too technical for me. But so I would see buy now, pay later. You have the asset. The asset has specific risk characteristics. There is legislation dealing with them. The fact that you bring it on chain, isolating the specific risks of bringing it on chain, I could not see how the risk is amplified. But I'd be happy to debate that if anyone else has different views. I mean, this is probably not a right or wrong answer, but it's a matter of how we look at it.
Okay, there's one more, and it's from Carl, just saying, it was about your earlier reference to DLT. He says, is he right in thinking this is not a public DLT and hence no consensus mechanism? That's a bit technical.
Yeah, I think so. I went to this tokenization conference the other day, and all the public blockchains were all the rage. And everyone was saying, you either go public blockchain or you might not at all. Technical elements aside, it would be really difficult for investors not to have, in certain types of transactions, not to have the expectation of some type of control, privacy, managing of conflicts of interest. And I am not entirely sure how in a public blockchain you can technically, well, and conceptually have that, because a public blockchain is by definition public. And some of these transactions tend to work best in an environment where you do have some barriers of information, you allocate risks in a certain way, and you manage conflicts of interest in an appropriate manner. So I think we're still far off from public blockchains instinctively, because I think you haven't actually done all the work to map out what you exactly need in terms of privacy, information barriers, flow of information, to make it available to everyone. And of course, then there's the regulatory aspect, so verification of identity for anti-money laundering controls, all of that, in a public blockchain, you will have, potentially some trouble unless you have digital identities that are already advanced.
There was actually a company called 21X that just got authorization today from the EU or, under the DLT pilot. And I believe that's a public blockchain, so it's probably quite an interesting case study to look at.
What's the name, sorry?
21X, the German.
21X. Definitely one to look out for. Thanks for.
Securitization.
Well, securitization is just for regular, but as an example of.
Yeah, Stephen, yeah.
Oh, sorry, me?
Yeah.
Just picking up on what you said about public versus private. Of course, a private blockchain would have fewer nodes and thereby be faster than say like a crypto, which is on, which requires. It's never over until the fat lady sings, and there's a lot of fat ladies on a public blockchain. So it's going to be a private blockchain. Period. Just like lots of the banks are developing private blockchains. On the securitization of tangible assets, like mortgages, in 2008, there was a massive crisis in the US because of this, because the US developed a ledger, not a blockchain ledger, but a ledger for securitization and the transfer of ownership of blocks of mortgage loans. The trouble was, when they came to have to enforce some of those mortgage loans and to gain possession or foreclose, as they do in the US, it didn't work because people defended themselves from foreclosure by saying, well, you haven't, the loan deed hasn't gone through the state's thing and had the state's authority and had a rubber stamp put on the document physically. And unless every state in the union does that, then that system fell over 100%. And so there are technical barriers to particularly with mortgage loans, where there's a mortgage contract and a debt contract in there, which would have to be overcome. Everything would have to be on the blockchain, and there would have to be changes in the legislation as to how those things are transferred in a judicial way. And the same would apply in every other jurisdiction in a different way. But those sorts of, so securitization of other things like buy now, pay later, or credit card debt, that's another ideal candidate. But mortgage loans is more problematical.
It ties in with registration requirements, with land ownership, with there's lots of adherence.
And there's lots of traditional methods of accomplishing the transfer of ownership of the debt, and which is tied to the title of the property. And that's going to be one of the last things that gets done, not one of the first.
I think it's been a long time in the making.
Yeah.
At least I've been hearing about it.
Yeah, you'll hear about it for a lot longer. I'm a mortgage person, you know, and you know, I don't lend money if I can't get a perfect title. And if it's on a blockchain, I can't get a perfect title because I don't know where it is.
Oh, yes. Question about digital currency. We have heard news saying that some central banks, like the Bank of England, is having things like digital pound, and other places like Hong Kong have saying digital Hong Kong dollar or digital yuan in China. To what extent do you think these sovereign or government-backed digital currency is affecting the scene of this blockchain DLT? Is it going to provide some regulatory certainty to or liquidity, something like that, or is?
From the perspective of a securitization lawyer, so not regulatory lawyer, not involved at all in digital currency work streams, if you have one other element that is on-chain, that's brownie points, because then that's one less segment of the transaction in which you'll have interoperability issues and, settlement delays because you are trying to bridge the gap between on-chain and off-chain. If that is going to come to fruition, and I've read a bit about the digital euro, of course, about, the views on other potential digital currencies. I'm not sure if that's going to come fast enough, and it will be, something that people will really be able to count on. Although there are reportedly already some experiences with central bank-driven initiatives that are encouraging. I think it's a space to watch.
Just to add to that, so the European Central Bank have promoted again a sort of pilot for digital currency. So the French Central Bank, Italians and the Germans have come up with 3 different ways of doing it as an experiment to see which is the best way of doing it, and that's been running for a while. And the important thing is then, as you say, is you bring together the cash side of it and the security side of it, so you get that atomic transaction when you settle the transactions.
Central bank digital currency will not be on blockchain, period. Central bank digital currency will be a fiat currency with a centralised ledger in the central bank. There'll be no compatibility with blockchain transactions of any description. You might be able to move money, your digital money, onto the blockchain, but it will be still fiat money that goes on there. Blockchain cryptocurrency is a zero-sum.
It doesn't have to be fiat currency, absolutely, but
You can't put fiat currency on a blockchain.
Do you think that's going to be kept into the future?
Well, the Bank of England's ploughing ahead with the possibility of fiat currency, a digital fiat currency. But that's a digital fiat currency. It's just like a digital pound that you have in your pocket. But it's not blockchain.
Again, a good example there is Finality, which has been authorised by the Bank of England to put central bank money onto blockchain using the various sort of facilities that the bank provide. So it's worth having a look at that, just to see that as an example.
Quite the interesting thing is most of these things, like, I think just to sort of, from what she's saying and from what I also know, most of these initiatives are still on a pilot basis. Yeah. So it's still sandboxing, and it's still sort of that experiment. What works? Okay, let's try this, let's try that. So it's quite fascinating that the industry is still, it will get there, but it's just a bit of trial and error in a sense.
They're still looking at use cases, aren't they, on the CDBC, Bank of England?
Yeah.
I don't think there's been a specific use case yet.
That's still on it, and they see they have this committee, and like you said, they don't have a specific use case at the moment, so they're just various bits and pieces that are trying to see whether it sticks.
It's worth pointing out about the question about quantum computing breaking the current encryption. But quantum computing will also bring quantum encryption. It's the flip side of it.
That's your answer. This is great to have such an audience.
I saw a number that increased the key
We're talking
2,000 from 100 to 1,000.
different countries, and are all of the different countries doing it themselves on their own? Is there any sort of joint going on? Are the Americans talking to the British, talking to the Europeans? And are the Europeans as a whole? Is it the French and the Germans and the Italians separately? And then what about the people in Singapore? What about the people in Japan? What about people in Australia? Is there a certain consensus going on, or is it everybody's just sort of running around like headless chickens trying to work out what's going on?
I think probably a bit of both, from what I could ascertain. So EU, of course, you have EU-wide initiatives, and those kind of tend to centralize. Of course, countries will still have some elements of discretion, national authority. So I was in a call today and people were comparing the approaches of the various competent authorities in relation to MICAR. So there is some disconnect there, but there is always disconnect. There is still disconnect about securitization regulation where you have national competent authorities kind of taking different stances on different things. So that is probably not going away, although there is an EU strategy and an EU regulation taking shape and a framework, and the EU pilot scheme is EU based, although implemented by the various states. On other countries, I am not aware of overarching initiatives other than Basel, the definition of crypto assets for Basel purposes, and that spans throughout a lot of countries, and industry association driven initiatives, and that is quite important. And that spans across the various areas. I tend to see the US a bit less represented. Maybe that's going to change now. Size of the pie, but tend to see the US a bit less represented on those groups. I don't know if anyone has a different experience from there.
With the DLT that's operating across jurisdictions, like for a securitization of assets, I can envisage governments insisting that they have the ability to switch off their server, their node, such that if they object to a particular transaction, will say, we'll switch off our node, therefore the blockchain will not complete, and it won't. So that will be one fat lady who's taken out of the chorus, and the transaction will be blocked. But they can just do that by a kill switch on their node. That would be their backstop. Because
we should be saying this to encourage the market.
but what I'm saying is that governments will not relinquish control. And if you imagine somebody like in the US, the SEC. So the SEC is going to say, okay, you can do that, but we want a kill switch. So they'll kill their node, and that means that the blockchain will tick, stop. And therefore it will not resolve. And so the whole transaction will unwind, because every node has to agree. That's the instance of a blockchain, whereas a central currency, central bank is a single ledger. There's no other ledgers.
I mean, there has been talk. Well, it was a press release, 7 March this year, if I'm not mistaken, about having an EU single ledger. So I think someone must have thought about what you're thinking. But the possibility of that going ahead in the near future, I don't know. You tell me if you think otherwise. But it seems like a difficult challenge.
So yeah, governments aren't going to let give up control of their money. That's for sure. That's absolutely for sure.
I've thought of another question. I mean, is this 100% definitely going to happen, or is there, because another way of looking at this technology is that it's just an alternative form of plumbing potentially for the financial markets, and you could do all the transactions could take place with cash or existing non-digital money. Although I sometimes struggle to see the difference, because in my bank account it's all digital; it's not sitting anywhere in a pile of notes. But could it just be a new form of just replace the clearinghouses and a lot of the back office work that goes on in banks and law firms, and just achieve a lot of the how much of the benefits could be achieved just by doing that without actually having necessarily a tokenized currency?
That makes me think about when we signed deals and using wet ink signatures for everyone. And then you started having digital alternatives, all scanning signature pages and signing through electronic platforms. And then when COVID came, you had to do it. So there's an element of you might need to do it, but there's also the element of it has become so much easier and so much cheaper and efficient to do it, that actually there is take-up. And there is, instead of having a massive back office, you kind of actually can trim it down a bit and invest in other, allocate your resources. So that is a bit fact dependent on, the way history goes and the world develops. But having the alternative and having an alternative that is credible, which I think is what we don't have yet, is really important, because you don't know if it's just simply going to coexist or if it's actually going to be the way forward. I think that's fact dependent. But it just reminds me of the transition between, signing on wet ink and now digital. Most of the deals we do now, we don't go around asking people to sign a piece of paper. They just scan it in or sign through DocuSign. So it's just the world changes and priorities change, and the way you allocate your resources, your energy, your staff, your cost. If there's a distinct advantage, someone will probably, it's like using computers. It'll naturally transition unless you have an external factor that makes it transition quicker for some reason.
I think the clue is in the name, digital ledger. It's a ledger, it's not an executionable thing per se. You can put executables on the ledger, but it's a ledger. So if you have a wet signature on a document, you scan it and you upload that to the node that you up to the blockchain, your bit of the blockchain, and that then stays there immutable. So you have the record, just like the National Archives or the Land Registry, an ideal candidate. It's a record, it's a ledger. The ledger might be a bit smart, it might be able to do some things, but the essence of it is it's a ledger, which is in effect a record, which is historic. It's a record, so you can go back and look at it. I'm losing my thread here a little bit. But the point is, it's a tool. It's the same as writing it in a ledger. It's just electronic, and and if it's an open one, everybody's got a copy of it, however many nodes there are. So that's why it's immutable. You can't change it.
But the transaction practices, the way of building consensus, the way of going about issues is going to be fundamentally different. And that's probably what's keeping it slightly less developed than it could.
Yeah.
Because it's just a representation of something you could have on paper, but it has implications on how parties actually, the dynamics of power, how everything revolves around.
Well, the insurance business is putting smart contracts on the blockchain so that they can automate claims and things of this nature. But the policy records are on the blockchain, and that means you can't change them. You can't say that the insurance company can't change the contract. Oh, it's already on the ledger, so you can't change it. It's like any form of accounting. You can go forward, but you can't go backwards with accounting. It's the same thing. You can only go forwards.
Okay, I think we have one question.
Just a couple of statements, really. Questions from Chikezie. There's the two aspects to blockchain: the distributed ledger and the cryptocurrency. It's perfectly possible for CDBC to be, or any accounting ledger for that matter, to use DLT technology. It just makes use of the properties. Which, i.e. immutable log of transactions. There's no relation on whether the currency has a limited supply or not. This upper limit is merely there, hyped up by the crypto ideologues. And another one just from Daniel. I believe in the Western world, if currency gets digitised, there'll be digital pound, digital dollar, and digital euro. I believe concerns about privacy hamper this.
Excellent.
Thank you.
All right. Right, that's the end of our Q&A session. Thank you very much to our speaker, Joana Fragata, for our presentation again.